webinar this morning, Friday morning, the 11th of September. We're very privileged to have three distinguished speakers on the panel this morning. I am Christelle Cronier, the Alumni Manager at USB, and we are very happy to present to you this morning this webinar called How Can Trust-Based Integrated Thinking Ensure Long-Term Value for Companies? Now, we're led by a USB alum in the facilitation this morning of this panel. This forms part of a series of alumni webinars. Of course, the alumni webinars are open to everybody, corporate students, and it is on behalf of the Alumni Association that we present this series of webinars hosted by sometimes USB alum based at our campus here in the Western Cape, sometimes by our chapter chairpersons in Africa or other parts in South Africa. So this morning we have one of our own lecturers, USB alum on campus, Brett Hamilton, that will be facilitating. I will be introducing Brett in a moment, but first welcome to all new people who've entered the room now. We are very happy to have you with us this morning. We look forward to your enthusiastic comments and discussions in the chat box as always. And if I may just go through some house rules. If you're comfortable, you may use your video. Please let people see who you are. It's also interesting for the facilitator and the speakers to see who they are talking to, but only if you are comfortable. It's time to grab that cup of coffee before we start at 10 o'clock promptly. And we're just waiting for a number of people still to enter the room. Welcome as you enter. Welcome. Please, may I ask you to please keep your microphone on mute for the duration of the presentation, unless otherwise guided by our facilitator for a question, answer, open floor discussion. And then you may all be aware that there is a chat box facility. Please use this vigorously. Post your questions in the Q&A. During the Q&A session, that will definitely all be addressed. But throughout the morning, please post your questions. This is an opportunity to engage with a distinguished group of three on very important issues in terms of long-term value for companies, governance, and other matters that our facilitator will be elaborating on just now. You may also raise your hand to ask a question or to indicate your enthusiasm for a comment made. So you are welcome to interact using the Zoom tools and the raise your hand tool. Our webinar this morning, just a warm welcome again to everybody who has just joined us now. I am Christelle Cronier, Alumni Manager at USB. And again, this is one of our series of webinars facilitated on behalf of the Alumni Association of the USB, either globally in the chapters or from the business school base itself. The title this morning, How Can Trust-Based Integrated Thinking Ensure Long-Term Value for Companies? I hope your coffee is ready. I will be then introducing you now to our facilitator for this morning, Mr. Brett Hamilton. Just a moment, bear with me please. Brett Hamilton is a visiting faculty member at the University of Stellenbosch Business School, where he teaches corporate finance on the MBA program. Brett has gained extensive experience in media, FMCG, agriculture, and property development. He is a director of First River Capital, a boutique firm that specializes in strategy, corporate finance, mergers, acquisitions, buyouts, and private equity. Brett, as an alum, holds an MBA from USB and completed the SMTP at USB Ed. He also holds certificates in advanced valuation from NYU Stern School of Business and NYU Advanced Valuation and Data Science and Business Analysis from McCombs School of Business at the University of Texas at Austin. Quite a mouthful. He is currently completing a postgraduate diploma in applied ethics at Stellenbosch University's Department of Philosophy. Brett, we want to thank you really for bringing this opportunity to us, for your initiative around this, for seeing the value and the importance, especially in the current circumstances, of us to take this into discussion. We highly value the industry leaders that you brought to this panel. This is another very good example of where the USB meets industry and provide the opportunity for our alumni. With that, we look forward to the session. Everybody, welcome again and enjoy the session. Brett, I'm handing over to you.
Thank you very much, Christelle, and welcome to everybody. I also just want to take this time to thank the USB Alumni Office for this opportunity. I think it's a great initiative for the school to give back not only to their current students, but also to past students. I do recognize a few names in the participant box of some of my former students. Some names I am not familiar with, my apologies for that. But yeah, welcome everybody. It's good to see, at least virtually see you again. So welcome everybody who has joined us live, and for those of you who are joining on the recording perhaps, also welcome and thank you very much for taking the time out. We know time is precious nowadays, and there's a lot of information going around with webinars like this. So we appreciate your commitment to USB, and I hope that you will find value in this. I think it's an important, what we are going to talk about is an important discussion to be having at this point in time, not only because of the impact of COVID and these sort of things, but just in general in any case. And it's only through rigorous debate and discussion that I think we will get to a better position from where we are right now. I'm more than privileged to introduce to you our two panelists today, Barrie, Jack, and Jonathan Rens. So thank you. Just hello, Barrie and Jonathan. So I met Barrie as part of training at the Institute of Directors of South Africa a couple of years ago. And since then, we've been engaging quite a bit about topics left, right, and center, to be honest. I won't waste too much time introducing Barrie. I'll rather let him introduce himself. So Barrie, if you are there, can you just give us a broad overview of your history with corporate governance?
Yeah, morning everybody. Thanks, Brett. Essentially, having served as a partner of one of the big four up until a long time ago, and then spending time on boards as financial director, and then over the last 20 or 25 years as an independent non-executive director of various companies, listed and non-listed. And the concern I have, and also as you mentioned there, Brett, the Institute of Directors as a facilitator for them on their director development and King 4, or King, whatever King it was at that time, but now King 4 programs, as you have attended. So I've been concerned with that in terms of better management of companies, better reporting of companies, and frankly, more and more concerned with when we talk about corporate governance, do we talk about good behavior in terms of how we come to being able to say, yes, this company is well governed in terms of that. Obviously, applying King, but also our concern, my concern has been what is the in the moment situation, the in the moment of decision making. So it's an interest of mine in that, in other words, to produce better companies, better directors, better companies. Mm-hmm.
Yeah,
that's it.
No, thank you very much for that, Barrie. Yeah, so a highly experienced panelist here, which I want to thank you for your time. Hopefully the participants would also be able to benefit from that experience and the concerns that you have. Jonathan, to you now, who's also a co-founder of Cantanoa. Jonathan, what is just give us a short intro of your background and your interaction with corporate governance, please.
Yeah. You know, for me, mine comes from a more practical side. I'm a quantity surveyor by training, so technically I'm supposed to only be able to count bricks. I never did it well, and I found myself on a number of boards, probably for more than 20 years, mostly at an operational level. So my interaction with corporate governance comes from more of an implementation side, because from an ops side, you're trying to manage culture, you're trying to make sure that everyone's kind of doing their thing. Again, you move to that in the moment. We'll talk a lot about that later. At a reporting level, what we've seen over the last 20 years is you started off with a very simple environment of really financials plus King, and that's moved into integrated reporting where it's become a lot more complex, a lot more going on. You've got the reporting, which is more about storytelling, describing the holistic view of the company in integrated reporting, which I think is a great thing. But it does have other side effects, which we can get into at some other stage. So in respect to the whole corporate governance, it's been for me experiencing that board, understanding the technical sides, and just trying to see, well, how do we actually bring corporate governance and the idea of ethics in business into the business all the way through. Yeah. So that's kind of where I come from.
100%. Perfect. Thank you very much for that, Jonathan. So yes, I think our panelists up to this point has mentioned quite a few not catchphrases, but phrases that we may be familiar with. And we'll get to that just now. Our specific topic that we're going to talk about, just to give you an overview quickly of how we're going to talk about it. Thank you very much for that, Christelle. I hope that was smooth and slick. We're going to have a discussion. I don't know how long it's going to take. I booked out this session for longer than what I think we needed, but you know, just to give some breathing room and not to make us too hot under the collar. We have time to engage with the panelists. If you have any questions, like Christelle mentioned, post it on the chat room. I will be trying my best to curate the chat room so that when we are finished with the panel discussion, which is much more of a formal sort of discussion, we can make the room open to sort of pertinent questions. Depending on the number of questions and the number of participants in the room at the moment, we may not get to all the questions, guys. We will try our best to still get answers to you, but we'll try our best at the end of the session to get through any questions that you may have until we run out of official time. So what has been mentioned, maybe just let me share my screen and make it look a bit more professional. So what we are going to talk about today is how trust-based, and the wording here is very important, trust-based integrated thinking can lead to long-term success for companies. All right, and our panelists have already mentioned three words: corporate governance, integrated reporting, and integrated thinking. Now, I'm pretty sure from all the names I've seen on the participants list that most of you are familiar with what this has or entails. But let me just give an holistic overview of what it is that we are going to talk about, and not necessarily the problem yet. I'll leave that to the panelists to delve into. But let's just sort of get through what corporate governance is in its simplest form. It simply is the systems, rules, practices, and processes that govern a company. It is the role of the board, obviously, in order to govern, which means it's the role of the board in order to implement, but also oversee oversee the implementation of governance within an organization. So basically what corporate governance is, it's about who gets to make what decisions and what should those decisions be. It speaks to the rights and the responsibilities of those role players within an organization. Examples of it, obviously we have the Constitution sitting at its most upper level. After that we have the common law. Then more practically or directly linked to companies, we have the Companies Act, and we have the King Codes, as well as, if you are corporate governance professionals in your organization, you may know a multitude of other legislations, rules, and things, even at the company level, that has to be implemented in order to govern effectively. Integrated reporting is simply a way, like Jonathan already mentioned, to holistically represent the performance and position of a company in terms of the 6 capitals, for one thing. But the idea with integrated reporting is to convey a true and transparent representation of the company to its stakeholders. The problem, and we'll talk a bit more about this problem that we have been facing and that we have experienced at First River, but also in academia, that we've noticed, is that despite increasing legislation, despite more boxes to be ticked, despite more training, all of these things, so corporate governance is becoming bigger and bigger and bigger, which is not only a cost implication, but also a time implication. The problem is we still see major corporate failures, as an example. So, you know, to attract people to a webinar like this, you always mention Steinhoff because people want to talk about Steinhoff. But there are a multitude of other examples of companies who have done wrong things, meaning they were not adhering to what the governance principles were requiring of them. If we move away from sort of the glitzy things that catch headlines, stuff like Steinhoff and these sort of companies, it simply also comes down to making good decisions within a company. And this is, I think, what is also important. It's not only about stopping stopping fraud or misrepresentation and these sort of, let's call it, bad things. It's also trying to implement a system that will allow a company to rest assured that everybody within the company is making good decisions. And I think we've seen enough bad decisions, not necessarily fraudulent, but just bad decisions that companies have made. And it is this mismatch that we are going to talk about this today. The mismatch between the desired outcome of what corporate governance was meant to achieve and what is actually happening in practice. Now, I want to make it clear that today's discussion is not necessarily the silver bullet. I'm pretty sure Barrie and Jonathan, they've thought about this a lot. But I think it is a discussion that we need to have. It is a discussion that we can't over-regulate, that you can't regulate or legislate good behavior. And I think that is the problem that a lot of companies are sitting with. And we're going to explore that. Again, not by necessarily offering you a perfect answer, but it is something that Barrie and Jonathan has been thinking about for quite a while, that they are concerned about. And we're going to see what they have to say about this. So thank you very much again, Barrie and Jonathan, for making your time available. Sorry, my chat room disappeared. There we go. So as we go along and as we talk, there might crop up things that you want to talk about or ask questions. Please just put that into the chat box. I'll make a note of it and hopefully we can come back to it. But let me start by initiating the conversation, I guess. Barrie, this is directed at you. When we consider the title of this discussion that we're going to have today, so how trust-based integrated thinking ensures long-term value for companies, you seem to imply this disconnect that I have alluded to in terms of the way that companies approach corporate governance. Do you think that this is the case? And can you expand on that, please?
Yes, thank you, Brett. When Jonathan and I have worked through this, we found that our experiences coming from different angles, perhaps on boards, have been pretty much similar. In other words, in a personal context, I want to be trusted. I'd like to think that people trust me. And when I do business, or be it personal or otherwise, with an individual or with an entity, I want to feel that I can trust them, that they will deliver what the promise is. So what we're saying then is that one of the key thing in any business is to be trusted. And your decision-making or the entity's decision-making should be based on trust. in terms of who is going to be impacted by the decision that they're making. So in essence, we're talking about in the moment, when we're making a decision, do we consider the impact of that decision on a wide range of people? And Jonathan, I think we'll be talking a bit later, maybe about the 6 capitals and so on, but which is a topic that's been around for a couple of years now, and from a financial reporting point of view as well. So my concern, and Jonathan shares it, and that's why where we've come to with Katana, is the simple fact that, do we consider how our staff feel about a decision, how our customers feel about a decision, how society, how the environment feels about a decision? Because think about it, a company is an incapacitated legal construct, and it only has personality and culture once there are people in the company, and it's the people that make the decisions. And as we do say, a company is the sum of its decision making. So our decision management and people making decisions, directors, considering the impact of their decisions on the level of trust, because the moment a company loses trust, there is a problem. Just think of the last 72 hours with Clicks, Unilever, and so on, with the Tresemme hair products. How that impacted a company. Presumably, they weren't thinking about the impact of the decision they were making, whoever it was, in designing an ad. They didn't think beyond what they imagined they were saying. I'm supposing, I wasn't in the room, obviously. So any decision that we make on behalf of a company, do we consider how that's going to affect the company's culture in terms of a trust-based culture? And of course, if you then go into the integrated report, you are effectively building the integrated report decision by decision.
Yeah. So, as I've mentioned and as Barrie pointed out now, there is obviously the goal that integrated reporting wants to achieve, and integrated thinking is sort of the systemic way of approaching things within the company in order to achieve those goals. However, you still sit with this problem that decisions have to be made at all levels within the company. And this is the in-the-moment gap that we have alluded to. So Jonathan, just on your point of view, how did you discover this in-the-moment problem or in-the-moment gap problem that Barrie has alluded to?
Well, I think it came about from actually doing the reports. You know, as you begin to tell the story of the company, there are 2 things that happen. One, you realize that you're telling the story after the event.
Yeah.
So you're always doing these things in the 3 months after your year end. If you just think about it very simplistically, you know, the year end comes to it, you've got your financials to do, which have become more pressurized and more difficult and more complex, with IFRS doing its thing. And you've got the integrated reporting, which is this wonderful opportunity of telling a holistic story about the company. But by the time you tell the story, there's a timing difference, firstly. And that timing difference is you're telling a story of what has happened. So in a sense, you like the accounting, the accounting reflects the past year, and you're telling the story of the past year. So there's an immediate impact to me. It was so clear to me that whatever happened, it's too late.
Yeah.
You see, whatever happened. So the issue then is to try and move the integrated thinking and the impact on how that all works happens 12 months before, or in a sense, almost up to 18 months before the actual report of it comes out. So this in the moment gap reflects this idea that we need to be putting integrated thinking in the 12 months prior to which we actually then produce the integrated report.
Yeah.
And practically, that's where there was a bit of a difficulty for me. So it was really in the actual assembling of the reports that I began to realize that, well, even the idea behind integrated reporting, this holistic story, what often happens is you've got a bunch of guys that are running around on the financial side, and it's really pressurized at that time. Those of you who've done it will know. On the other hand, you've got the integrated reporting, which starts to become a bit of a marketing feel to it, because it's about telling the story. It's got a lot of visual representation. It's trying to keep everyone engaged in the story of the company holistically and in all those ways. So you've now got the sense of an engaging, marketing-oriented story being told. Within those 3 months, you've got the financials, which everyone's going to settle. You put those together. Well, there's very little connection between that and the in-the-moment decision-making at an operational level, you know, prior to these things coming into place. So that's kind of where this in-the-moment problem came. You know, if I'm in the old days when we tick boxes, let's say when King was more of a ticking of a box scenario. I mean, you're ticking the box literally, let's say, you know, anything from 12 to 14 months after it actually happened. So there's your in-the-moment gap.
Yeah. So Barrie, yourself have already mentioned this sort of, let's call it, I don't want to call it a catchphrase because, sorry about that. Yeah, so that's a very interesting point that you're raising, Jonathan. And I think most of us who are practitioners in this world will sort of feel very familiar with that situation that you've just described, of sort of once a year you go through this process, making sure that you're ticking all the boxes, that it looks good. Obviously not misrepresentation, but you're sort of just ensuring that you're doing what you're meant to be doing. However, this is in retrospect of when what you are reporting on actually occurred. So basically, we've already alluded to the fact that corporate governance relates to decisions that are made within the organization. And in earlier discussions that we've had running up to this, we've had a few meetings, you have a nice catchphrase which basically just says that every organization, no matter how big, how small, what industry, every organization, and to a certain extent any institution, is simply a sum of all of its decisions, which means what we do on a daily basis influences what we do over the long term, and we are what we decide. And this is again an interesting thing that links to integrated thinking. And can you just tell us a little bit more specifically how that idea of an organization being the sum of all of its decisions, how does that link practically then to integrated thinking and this in-the-moment gap that you have identified?
Yeah, so there's a lovely quote that I think describes things much better than I do. I'm not always the most articulate person. It comes from a guy called Richard Weaver. He said that he said the following: "We do not undertake to reason about anything until we have been drawn to it by effective interest. And in the cultural life of man, therefore, the fact of paramount importance about anyone is his attitude to the world. How frequently it is brought to our attention that nothing good can be done if the will is wrong. Not without cause has the devil been called the prince of lawyers, and not by accidents are Shakespeare's villains good reasoners. If the disposition is wrong, reason increases the malfeasance. If the disposition is right, reason orders and furthers the good." And that's, for me, quite a powerful summary of the importance of integrated thinking, because if we could somehow bring integrated thinking and give it a bit more life in the moment, what it has is it has the opportunity then to be the driving force behind decisions. Because ultimately, when we make decisions off an attitude. We make decisions off of presuppositions. We make decisions based on experience. We make decisions, you know, Daniel Kahneman has done a lot of work in that. But the decisions come from somewhere. And so if we can start to build a kind of an integrated thinking, take the idea and expand and play with it a little bit, we can then impact the decisions, because all companies it's trite that every company is usually the sum of its decisions. If all the decisions are made off the basis of integrated thinking, then you start to immediately, without doing anything else, you start to impact and create a kind of integrated culture. And what that then means is that the integrated report that comes out of the process is not something that gets written, you know, in the last couple of months, getting ready for taking to market with the financials, but rather what it is, it's an automatic overflow of the thinking. So so the gap that there seems to be to me is this idea of, if we can increase the thinking into the decisions, put the decisions become the culture, actually then itself writes the report, and you can then have probably a better chance of an authentically orientated integrated report. I'm not suggesting that everyone's inauthentic and not pointing fingers, but it just becomes a lot more, there's a lot more integrity in the process if you see those steps. By having step 1, integrated thinking, integrated report is step 4, it seems to me we're missing a little bit in the middle.
Yeah, this is a very interesting gap. I mean, that is in effect the gap that you're talking about. And the discussion that we're having today is ways in which we can fill that gap. And again, like I said, we're not offering the silver bullet, but I think what will be required is an open and honest admittance that there is a gap between integrated thinking and integrated reporting. The consequences of it can be dire. It may not be immediately apparent, but it is there. And not a lot or not enough of discussions around corporate governance matters, I think, addresses this head on. And to be honest, I think we as academics, we often try to distance ourselves or make ourselves objective in the process of analyzing and considering corporate governance. But in the end, corporate governance is not only, I mean, when you talk about corporate governance sitting at the decision level, that is where it sits. And every decision at every level of the organization is then linked in this sense to corporate governance. What this means is it's an immersive process. It is a process where everybody in the company is involved at every level. And in order, I think, to ensure that the outcomes that we want to achieve are achieved, we cannot disregard the complexity of the problem that we're sitting with. What I do appreciate, Jonathan, is I know you're a person of practice and not necessarily an academic who does sort of academic research, but you mentioned a few words here in terms of reason. You've mentioned a few things that sort of relate to philosophical thinking, which is, I think, crucial here, especially when you talk about something as difficult or complex. Let's use that word complex specifically as culture. So I think what is very important here is to understand that when decisions are made, there are the nitty-gritty calculation side of it, the tick boxes, the regulations are there, they are clearly articulated, the rule books are there. But then there's also the ethical side. So the moral dilemmas that we are faced with when we have to make certain decisions, and not always a moral dilemma, just we have to make decisions that maybe sometimes we're not quite sure of what the true impact of it could be. So Jonathan, just to sort of go a little bit deeper in this discussion, where does values sit in this process that you are putting forward or talking about?
I think values is the core values, and corporate values are the things that we have been using to drive culture. That's the idea behind them. And I support that. But for me, there's a sense of values are great, but they're not quite enough. Okay. So Elizabeth Murdoch put it well. She, from Shine, in the Murdoch family, when they had that whole telephone and hacking scandal, she said something in a lecture. She said the following: obviously, News Corp is also a company that is currently asking itself some very significant, difficult questions about how some behaviors fell so far short of its values. Now, personally, I believe that the biggest lesson in the past year has been the need for any organization, and this is the point that she makes. I think that's, well, certainly I took it as something that really spoke to me. She said that we need, all organizations need to discuss, affirm, institutionalize a rigorous set of values based on an explicit statement of purpose. So what she's actually saying here is that if you think of the process of values, you're trying to reduce everything down to such a raw simplicity that the question then becomes, how does the average guy in the organization build his everyday life around something that's been reduced in sort of a reductionist kind of a way? And in a sense, I think it becomes a little bit, again, falling into here are our values and we market them, but how do they practically apply? Now, if you then start to connect that with integrated thinking, and the integrated thinking, the definition, which is more about thinking, you say, well, maybe there's a way if we can build off the values into more rigorous environment. And if you think of culture is not just based on values, it is, but there's also this idea of some kind of values-based thinking. You have to also push out an attitude. If you look at it in the slide below, you've got the models for integrated thinking should include the values. It should include the way we do things, the people that are heroes, the stories of the organization, certain things that we do. So in a sense, the values is the right mechanism, but I think it's just a little bit light. It needs to be in the reductions form, but it also then needs to be maybe blown up to give a little bit of a framework so people can understand that. And then that becomes strong enough for all the decisions related to the organization's operations and activities. Because if you think about our contending, our purpose, our goals, our strategies, the practices, our processes, all those things involve decisions, and they need to sit on something. And sometimes I get the feeling that having 4 or 5 little values, it's just not a big enough foundation. It's not strong enough to guide the complexity and extent of decision making in the organization. So to me, values is kind of like one of those building blocks for building this, Catano thinking and Catano. We need to bring the values into the thinking rather than leaving the thinking of kind of where it is now.
Yeah, that's an interesting point. And this is an ethical point, which I think is also something to really consider when you are a governance practitioner, or just simply you have to make a decision within the company. And Jonathan, what you mentioned is quite pertinent here, because how an organization works, what an organization is, if we frame the organization to, let's just say we limit it as the company, and all the role players within that company who are autonomous, meaning they are free to make decisions what they deem to be the right decision. So they are all after their own goals and seeking their own sort of outcomes. And this sort of links to that agency problem. You have freedom on the one end, which is people have to make decisions to do what they want to do, basically. But then from the company's point of view, and like you said, people have values, but then the company also has values. And this is a tricky thing in order to navigate in terms of ensuring that the people within an organization make those decisions that link to the values of the company. Now, what is clear is that even individuals themselves find it very difficult to know what their own values are, or even if they are aware of what those values are, and this is a very important point, those values, let's call it ethics, those models that you can use and ethical considerations in order to what is a good decision is not always so clear either. So there's this whole gray area of what is right and what is wrong, even within our own selves. And then to make it even more complex, you have a company that must define for itself, through the people making decisions within that company, what is it that is right and what is wrong. And this is a very difficult thing. And it, like you mentioned, it does link to culture. However, because of this complexity, because of this grayness, and because of the ambiguity, meaning the simple fact that my values are not always the same as yours, more than okay, doesn't make it right or wrong. It's just different for many reasons. That makes it a very difficult thing in order to implement and control. And the problem with corporate governance, I feel, at least the why that gap could be there, is this distance between the rigid, what is right and what is wrong. We want to codify. You mentioned the word reductionist. That is exactly what it is. We want to put a science behind good governance within a company. Tick these boxes and you'll be okay. And what we've seen is that that is not always the case. There's a disconnect here.
Can I, it's so true. Can I just give you a quote on that? Because this wrestler
Absolutely,
that you
go for it.
have, I'm sorry to interrupt you there, but there's
No
this
worries.
wrestler. So Bob Diamond from when he was with the, I think it was Bob Diamond anyway. Barclays, the Barclays Diamond guy. He said nothing is more important, and this was in an email, by the way, that he sent to all his staff. I think it was in the corporate finance side during the financial crisis. He said nothing is more important than having a strong culture at Barclays. I'm sorry that some people acted in a manner not consistent with our culture and values. This is the wrestler is, as you say, the corporation needs to have the tools to set and embed its culture. In a sense, this involves a method of thinking that produces decisions, because culture is the way we do things.
Yeah.
The problem is everyone brings their own culture and their own method and their own attitudes to work, and there's your battleground.
Yeah, and I think what corporate governance attempted to do was to bring everything in
If
line.
I may jump in there, Brett.
Yeah, Barrie.
That comment or that email by Bob Diamond followed the LIBOR crisis, where a number of the banks were caught out.
Indeed.
And you know, if one looks at just put up slide 3, if you wouldn't mind, Brett, if you've got it there. 3, yeah, other way around.
That one.
Yeah. If you think about it, if any group of people will have different sets of attitudes, values, rituals, heroes, stories, and symbols, as is there under the model for integrated thinking. But the corporate culture, the way we are going to work, if you think about it, when we sit down, if the 3 of us or everybody on this call are part of a company, and we sit down to explain how our values work, when we set our little value statement, presumably we make those value statements so that we'll be trusted. So that result in conformity of behavior. If you think of the Johnson & Johnson crisis back in 1982, there was a situation with the Tylenol crisis, and the chairman at the time pointed to the Johnson & Johnson's credo. Now, at that time, Johnson & Johnson would have been made up with a wide range of people, diversity of background, culture, and values. But the values that Johnson & Johnson stood for was that credo. And if you can't live with that, then you don't belong here.
Yes.
So that's where those values are. And when you're making decisions, are they in line with those values? Will they still result in trust? So that's the question that I think we have to look at.
That's extremely important. And just to sort of throw a spanner in the works with this, and it is our very own Stellenbosch University's Professor Celia at the philosophy department, who said, sort of built on the work of complexity and postmodernism, but the idea was put forward that if what we are working with is not only complicated, meaning a very difficult thing, but it can be modeled, it can be sort of replicated and implemented through tick boxes, but what we are truly working with is something that is complex, then what we know, what we can do, what we assert will never have 100% certainty. And I think this is an extremely important thing to admit to ourselves, that when we make decisions, we do so with imperfect knowledge. We do so under uncertain uncertainty, under conditions of uncertainty. But the problem is, guys, we still have to make a decision. So we can't say I have no perfect knowledge. Until I do so, I won't make a decision. I can't say that I don't have certainty, so I'm not going to make a decision until I have certainty. We have to make a decision, which means you are asserting yourself when you make a decision. So in the context of having imperfect knowledge, imperfect insight, and never knowing what the future is going to hold, which I think we can all agree is what a company is. If we admit that, what is required, and this is what Professor Celia said, we need to make responsible decisions. We need to, from a position of modesty, make assertions. So not be 100% certain of what we are going to decide was necessarily right or wrong at the time. But we need still a way to understand, to some extent, do the calculations, do the tick boxes, understand what is expected of us. And then you have to make this leap to the actual decision. And people within an organization will need assistance with this process of taking that leap from, I know that what the decision that I'm making now is going to be considered, at least from the company's point of view, the right decision. And this is where responsible leadership, I think, fits in very nicely. So what I think is clear, Jonathan, is that integrated thinking seems to be a bit more complex than what we may have thought it is.
Yes.
It's mentioned everywhere. King mentions it. I mean, integrated reporting networks mention it, but they fall short in terms of that how. How do I do it? I know what I want to, the outcome I want to reach. I want to have a values-driven organization. That's great. I want my office workers to make decisions that link to my values. This is great desires to have, but the how is sometimes missing. So what do you mean by integrated thinking? What is Catanoa's view of integrated thinking?
Okay, so Catanoa tries. I just can't resist. I've got to come to your comment about Professor Zelius. The comment that we need to in humility recognize the fact that we don't have full knowledge. I think he's just so right, and it's actually quite relieving when you know that you don't have to know everything. It helps you. One of the problems with postmodernity, though, is that it's driven off not so much a philosophy, but an anti-philosophy. And at the heart of it is this idea that there is no meta story, that there is no bigger thing, that the person is sacrosanct, the individual's ability to do their own thing, its subjective values, subjective morals, all those sorts of things. And the difficulty that the corporation has in a postmodern world, and as we've seen this move into different parts of culture, is that doesn't work in a company, because we actually have to unify the way we decide and do things in the organization. You cannot apply the postmodern thinking to say that, there's no meta story. Well, in the company, there is a meta story. It's how we do things here. See? And that's got to transcend all personal views of life. When you come here, that's how we work. So driven and built off that realization of where we sit, what I've tried to do, if you can imagine, integrated thinking is defined in King and defined in integrated reporting in the US, it really tries to link the operations to the 6 capitals. So there's some 6 capitals and they represent certain things. The problem with 6 capitals is, I think if you did a survey of any big company, most of them wouldn't even be able to list them for you, let alone understand them. Then you've got the values of the organization, and these are just critical as to where we're trying to go and how we're doing, and the values of where we're going with the strategy. And then you've got stakeholders. You see, that's the other big thing starting to move into this conversation. And we have this big debate around stakeholders versus shareholder value, which of course is nonsense, because shareholders are stakeholders. So, it starts to get messy. So what we try and do is we try and say, let's take the concept of integrated thinking and, like a balloon, let's just blow it up. So we hit the kind of like the center point of all those 3. So the idea behind the Catanoa trust-based integrated thinking is that let's create a series of considerations that we incorporate and we map out together. And there is a total of, there are 3 categories, each with the other 3, and they're total of 27. And what we do is we then say, well, when we make decisions, because that's where it all happens, it's got to come back to that moment of decision, okay? If you put up the next slide, you can actually start to see this. What we do is we've got these 3 real bigger areas. We've got the outside, the things that are beyond the company, all those considerations. We've then got the strategy and the functioning of the organization, its purpose and all that stuff, which is inside, and then the stakeholders within the organization. It's the people and the team and providers of human resources and financial resources, all that sort of stuff. So what we're really trying to say is this, is what if every person in the organization approached their decisions by checking out the impact of those decisions on all the considerations, from a perspective and ask themselves a very simple question. If the proposed decision goes ahead, what's the impact of trust in and towards this organization if we implement a recommendation? So that's the question that drives the decision making. So I come to this decision. The decision making is like a stop street. Which way am I going to go? Am I going to go straight, left, right? Where am I going to go? And I then just have a look around, do a bit of a scan, have a look and see what is the impact of all the considerations around all the stakeholders, around all the impact, the intangibles, things like financial sustainability, R&D, all the kind of things that impact. And we've mapped those within Catch and Know. So for us, what we're trying to say is the concept of integrated reporting, of integrated thinking, leading to integrated decisions, producing integrated culture, that flow is something I think is really powerful. And if we can just get take values and all these other things into a model at the integrated thinking level, if that can be implemented at a corporate level, well, now you've got the foundation from which you can produce integrated decisions, from which culture can then naturally flow, because it's big enough to carry the burden of the decisions that are made in the life of the organization by everybody. So that's the kind of big play that we're after. That's what we're kind of after. Is this a thinking that is it sets a standard for how we think in an organization. It contextualizes that organization, and then what happens? That organization instills that. It's not in conflict with values. In fact, it's just a blown up version of some of the values. So it actually builds itself of value, and that's the idea.
Yeah. Barrie, just linking to this, I mean, at the center, we just have a few members who are not muted. Hopefully it will go away. All right. Barrie, just linking to this, in the middle of this sort of model, your integrated thinking model, you have impact on trustworthiness and fairness. Why do you think trustworthiness and fairness are at the center of your decision-making methodology? Why is that the core?
Thanks, Brett. You know, the way we've been talking, we are obviously concerned that being trustworthy and making decisions that will be trusted by stakeholders, both internal and external, which is what the slide looks at, is fundamental to the value and the quality of those decisions and the success of those decisions, frankly.
Yeah, yeah.
However, there will be times where, and of course, trustworthiness is ultimately determined or confirmed by the trustee delivering on the promise made.
Yeah.
If the trustee can't, for some reason, deliver on the trust, which might be beyond their control, and they come back to the trustor or the customer, if you like, and explain the circumstance and propose a solution to it which meets the criteria of the trustor, that's being fair. In other words, yes, I made that promise, but there's a shortage of whatever it is that I need to fulfill my delivery. So I'm going to go and source that at my own expense from another provider, although it's going to be more expensive, but I'm going to treat you fairly.
Yeah.
That would retain and maintain the level of trust. So behaving fairly, I mean, in the insurance and banking industries, you would know, the old FSB talked about treating customers fairly, TFC. And what they were saying is, are you attending to the needs of your customer? But that's true in a trustworthy fairness basis. In other words, I will trust you if you continue to treat me fairly, even if it means that your ultimate delivery is not going to be quite what I wanted, but you've been fair and I understand why. So this talks to the relationship between the person asking for the product and the person making the promise. Trustworthy fairness, and fairness will go a long way to preventing damage to the trust.
Yeah, 100%, 100%. So Barrie, then what do you see as the biggest challenge of implementing your view or even other views of integrated thinking then in an organization?
Well, really, if you think about it, the way the situation, the trust situation needs to be embedded. We call it the Catano decision and basis and the Catano promise. In other words, are we embedding this culture of trust throughout the organization? And frankly, ideally, it starts with when management sits down to do the strategic plan. Is everything in the strategic plan going to result in us being trustworthy and being trusted by all our stakeholders? And then as we move through the year, making decisions against the backdrop of the strategic plan, which will change given circumstances, are we still maintaining that trust? And are we being fair to our stakeholders? So that would then mean that we can continue going forward. So, but it needs to be embedded in the organization. Trust is not just for the executive and senior team and the non-executives, it's for middle management right down to staff. And they need to understand. One of the tests of trust, obviously, is to talk to somebody at a junior level of staff and ask them, do you trust your immediate superior? Do you trust the top management? Or do you live in an environment where there's this disconnect and you feel discomforted? Because a person like that's probably not going to stay for long. And that's when you lose your best people. So this, the slide, I think, you put up the slide number 5. It has to be implemented throughout the organization. And as that flows bottom up, having the process and the values being set top down, then decisions will be made appropriately. So, and we come back to the in the moment decision making, that we consider whether or not it's going to be trustworthy or damaging. It may well be that a decision, when looking at a decision and we consider that decision, and we see there's a bit of a negative consequence for that decision on some stakeholder or stakeholders. So, but it's a good business decision for the business. And after all, the directors have to make decisions in the best interests of the business. In that situation, they would then need to consider what mitigation can they put in place. So for example, and it's an old hackneyed one that I use, and you've heard me talk about this, Brett. I think it was Richard Bay Minerals when they were going to mine, many years ago, they were going to mine the mine dumps, the sand dunes. Yeah. Silicon or something down in La Lucia. And the concern was, yes, but the little animals, and as we say, there's always a frog that's nearly extinct. And then there's all the vegetation, and it's sensitive vegetation. If you mine there, that'll all be wiped out and that it'll be lost to us. So they realized that. And what they did was that they built greenhouses and they incubated the plants, and they got all the wildlife that they could, all the frogs and the insects and so on. And then about a month or 2 after they had finished their mining, the mine dumps were reconstituted, and they put the plants back and they put the animals back, and they made sure, using environmentalists and all those sorts of people, zoologists and biologists and so on, that in fact, you cannot now, if you go there, see that that was ever mined. So it was a negative at the time of the decision, but they took action to be fair to the environment, and they reconstituted it as to where it was before. So in that sense, that was, at the end of the day, a trustworthy, fair decision. I don't know if that answers that long way around.
Yeah, and I think obviously it links back to transparency, and that is the whole goal, I feel, of integrated reporting and integrated thinking as the process. But integrated reporting requires of a company to be transparent. And I think transparency is one of those key requirements for trust to develop, which basically means, Barry, you mentioned, do I trust my superior? Do I trust senior managers? I think a lot of the issues that we have seen, not necessarily from corporate failures. I mean, obviously the trust relationship doesn't exist or shouldn't exist. But a lot of if the answer is I cannot trust my superior, it would invariably in some way link to you not having insight into their decision-making processes that impact you.
Okay, I'll get to that now.
And I think that is crucial from an integrated reporting point of view. And Jonathan, you mentioned it. Integrated reporting sort of almost falling onto the PR side of the corporate office, the CEO's office, as opposed to the actual CEO spending time on ensuring that this is a document that is transparent about the decisions that are made within the business that impact others. So that is internal and external to the company. Because without that transparency, without there being this openness, not necessarily to share all of your secrets, that is not the idea here, but to be transparent about what it is that you are, what you want to achieve, and I think how you want to achieve it. If a company cannot be open about that to their employees specifically, or to external parties. Barrie, you mentioned now the sand dunes, that community. You must be transparent in that process so that the community can trust that you will deliver on your promise. And then it is okay for you to perhaps come and operate there. If there's no transparency, if they do not believe in your promises, you will not be able to make a decision, or then there's no option for you to even go and mine there, as an example. So I think that is a very crucial thing, that link with transparency and trust, the link with transparency and integrated reporting. The only problem is you want that transparency throughout the entire organization.
And I think you're absolutely right, because if you're going to be transparent, then the transparency has to be kind of throughout the whole organization. The slide we've got there on the practical implementation. So the way that we apply these two things, you'll see there's the cat-no decisions, and then you've got the cat-no promise. Just to clarify that a little bit, for those who might be wondering, the big old question is, a nice theory, how do you do it? Again, my background is on ops side, and I always want to kind of connect the esoterical, whatever the word is, discussions at board, because, you know, I got to actually make them happen on the ground. So in one sense, what you're trying to do is you're trying to build into the organization idea of promise and delivery. And so what we're suggesting is at a practical level, is that everybody in the organization make a promise to each other. So this is from the top down. It's from the CEO to the person who basically sits at reception, or whoever it might be, the person digging trenches, doesn't matter. Everyone comes with a very simple promise. It says the following: because trust is primary and everything else is secondary. And that, I suppose, is a big statement that we make. And anyone who doesn't believe that trust is primary and everything else is secondary, well, I'm open to that conversation. I haven't lost that one yet. Anyway, because trust is primary and everything else is secondary, I, the person, promises to whom? The company and my fellow workers. So you're creating a sense of promise and delivery between people within the organization. So what do I promise? I promise to act in accordance with the organization's values. I promise to underpin trust with fairness. I promise to think about outcomes before I act, and I promise to stay on track. Now, those sort of statements are very basic statements, and everybody will be able to contextualize those very, very simple statements in their daily lives. And that brings a sense of cat-and-no trust-based integrated thinking, because that's the core of the integrated thinking that we believe. But when you come to the bigger decisions, when you, let's say, sitting at your executive decision, board decisions, this promise is not enough. Yes, it's the core of it. So what we have is we have cat-and-no decisions. And in the cat-and-no decisions, what we do is we have a scorecard where every one of the considerations that exists principally within that the organization faces is presented as part of the proposition or the proposed decision. So I'm proposing this decision, and I actually score the outcomes. I score the outcomes against all the different considerations. There are 27 of them, and they deal with every aspect that the company actually faces. And when we look at each of those considerations, the first thing we say is, what are the assumptions? So, for example, if one of the considerations is financial sustainability. Well, you know what? If I can, through assumptions, change anything from bad to good or good to bad. Okay. If I put cost of capital at 35%, I can promise you it's going to be bad for the financial sustainability. If I put it at 0, it's going to be good. So again, we list those. This is at the board level. The executive, the non-executive can look at the scorecard and they immediately get a sense of, okay, what are the big issues related to the scorecard? What are the things that can be impacted by this? What are the assumptions related to it? On a single, basically 1-2 pieces of paper, and right, how does that, what is the trust impact on this? What's the impact of trust on these? If we accept this decision, as has been proposed, is it green to red? There's no right or wrong answer. There's no counting to 10. Let's get a 9 out of 10 score for a decision. That just can't be the case. As Professor Celia said. So what is, and you effectively score the decision. And what happens is this, is you find, hang on, there's some issues here. I don't like the way this is. There are too many reds. And then you revise the recommendation, you play with it and you work with it, and you're then able to get to a better decision. So at a senior level, the whole idea of the Kaplan integrated thinking takes on quite a detailed scorecard effect. At a grassroots level, it's a basic promise. And as one builds from grassroots in organization up to the train to the executive office, so what the Kaplan promises and what the considerations mean and how they impact, they kind of grow with you as you grow up. And in that way, you're then able to build a single kind of model of thinking into the organization that can start at the bottom up through the promise and can then move from the top down through the decision scorecard. So it's a very practical thing. Non-execs, of course, have tremendous get value out of it, because generally they come in, they don't really know, they've been given a pack. And generally not the night before, I'm joking, but they don't get 2 weeks to read it. It's like, hundreds of pages deep. They don't have context. They're not living in it. But these scorecards are then able to help them, because there's an immediate sense of what's the outcome. And it's interesting, Professor King has just written a book on outcomes. And what I think he's picking up on, I haven't read the book, what he's picking up is that we need to consider the outcomes of these decisions against the stakeholders. So. Yeah. One of our stakeholders are shareholders. They're not the only stakeholders, but they're one of them. Okay, so what's the impact of that on the expected risk-adjusted rate of return of the investment into this property, into this company? Are they entitled to everything and we rape all other considerations just for shareholders? Well, of course not. But they deserve a fair, and they deserve that we run the company in a way that keeps trust, because if we run the company that is in the interest of the company, and maintains trust levels across all the considerations, well, that ultimately is going to maximize shareholder value. It's really, I suppose, what we're suggesting.
Absolutely, yeah, and I think it links very nicely with what we've discussed.
Thanks, John. There's a lot of interesting comments, Brett, that have come through the chat room from Len and Liania, Malcolm and Melanie and Colin and so on. And while Jonathan was talking, I was reading through them. Okay. And it is interesting. One of the questions which Jonathan's addressed, is there a practical implementation way of implementing? Yes, we believe that there is. I think in the, one needs to understand in the affairs of man that I guess mistakes will always be made. We may make a decision and we've scored it, and then we find that the exchange rate changes or the weather doesn't do what we want it to do, and so things. We're not trying to say that we make people infallible. That's not what it's saying. What it's saying is, can we trust the decision we're making? Can people that are impacted by the decisions we're making trust them? And trust is built over a period of time, not just with one transaction. So can the track record of my behavior to you result in trust? Now, that could be my behavior to my immediate boss, to my colleagues around me, and to the staff that report to me. Can they trust the way I behave? And the way I behave is in my everyday behavior. And that then, if that becomes the culture within the business, it starts to have an impact on the business being trustworthy in its decision-making. So yes, and obviously there needs to be training, there needs to be explanations to everybody as to what does trust mean, what does being fair and transparent mean. Brett, you mentioned transparency. Without transparency, we don't get the measurement of whether the trust is being lived properly. And as Bob Diamond said in his email to his staff, this is how we behave. If you can't subscribe to that, leave. You don't belong here. And I think that sounds harsh and blunt, but it's true. So this is the culture of this company. This is how we behave. We want all our customers to trust us. We want to behave in a trustworthy way to all our suppliers, to our staff, and to anybody who might be impacted right the way down the line. It could be that our product has a negative effect to certain people because of certain health factors. We need to think about that, and what are we going to do about that? Because at the end of the day, we may have to take responsibility for it. So I don't know if that talks to some of the things. I like the comments, which I want to read without having to try and listen to what everybody's saying at the same time as read them. But I do thank everybody for their comments. Back to you, Brett.
No, Barry, I think Collins was the only question at the bottom, and it sort of links to what was being discussed in the chat room on top. I think a lot of the participants sort of agreed with what we have been saying in terms of the challenges that they are facing, which means I think we have sort of struck a chord in terms of those who are practitioners of these. And when I say practitioners, everybody is a practitioner of corporate governance, because everybody must make, or anybody who makes a decision within the business or performs an activity in the business is in fact involved with corporate governance. So I like this one from Malcolm. Malcolm just mentioned that in the Companies Act itself, they do mention this requirement that standards of directors states that directors must be able to trust and rely on staff members, council committees, which means there is a requirement to develop that trust. And what Colin, I think, mentions is that when you have values within an organization, the metrics against which the performance linked to the outcomes of decisions of that performance of individuals are made within the company, it must link to the values. And very often we see that is not the case. And guys, why I decided I wanted to introduce this topic to USB was not necessarily that this is the absolute perfect model to follow, but it is a model that requires a company to carefully consider what are our values, what is right and wrong, what are the outcomes we want to achieve, and then finally, how are we going to instill measurements or ways of control that drills down through the entire organization in order to ensure that we do live those values. And I know living those values, it sounds airy-fairy and wishy-washy, but that is what it is about. And when you see corporate failures, when you see people not making good decisions because they're uncertain of what a good decision is, that stems from a lack of insight, a lack of knowledge, a lack of, let's call it a lack of direction. And the compass is corporate governance, the compass that steers you in terms of what decision to make. And just to summarize then, perhaps, before we move on to a few other comments, and hopefully Barry and Jonathan will agree with me here. Jonathan, you spoke about the practical side of implementing this, your scorecard that is linked to the values and the desired outcomes of the company. What it boils down to is the following. For those who have to make decisions and those who have to review or oversee decisions, so in this case, the board, especially the non-executives who come in every so often into a business and then have to fully understand what the business has been doing. A process that links all the way through the business in such a way provides that transparency. It provides a way of understanding what decisions were made, why were they made, and very importantly, what assumptions were they based on. There's a way for someone to drill down into a decision, to follow the thought process. That will allow you, especially as a non-exec, on a board level, to say, I agree with this decision or I do not agree with this decision. Without having that detail in a very concise way, it's a very difficult thing to evaluate. And then second...
Sorry, before you go to the second thing, I think what you've hit there is such an important point. we spoke and you mentioned this whole idea of transparency. When you've got a scorecard that you actually have debated the decision and you've managed based on the knowledge at the time, any question related to how did you get to that decision becomes a record based on the scorecard.
Yeah.
And what is then as a protection for directors, and we all feel the pressure that has been put on directors in terms of responsibilities that's growing. The question is, have you applied your mind?
Yes.
Okay. And so when we make decisions, the question, the modern, again, coming back to your post-modernity side of things, the modern question that people ask is, how do you feel about this?
Yes,
okay.
sir.
Right. But actually, the real question that we're being asked and we will be judged on is, how do you think about it?
Yes.
What do you think about it? Not how do you feel about it?
Yeah.
And having the scorecard and the standard methodology that is put in, contextualized the organization, your strategies run through it, it's built off the values, which is really what this thing ultimately represents. Whenever there's a question around a decision, because, and I'm talking about the executive decisions, there's a way that one can say, we applied our minds.
Yes.
Here it is, 5 years after the event. And because people have very short memories, they judge past decisions based on current knowledge.
Yes.
But what knowledge did I have at that point in time? So I think one of the nice things about Catch and Noah is when it's at its more formal level, which is in the high levels, is exactly as you say. It has this ability it de-risks the members of the board, it de-risks the company, and it adds transparency. That's how we got to the decision.
Yes.
Life is simple. So yeah, I think that's also part of the intention behind it. Sorry to interrupt, but I like your point, man. Yeah.
Absolutely. No. So what I always say in my class, because I have a session on corporate governance in the strategy module on the MBA, is there are certain roles and responsibilities given that are inherent to, let's say, a board member. But this is true for any employee in the organization. But the board member has to be able to justify the decisions that they've made. So when it comes down to a matter, let's just say in the court of law, you must be able to say why you made this decision, what you based that decision on, and given that knowledge at the time, why it was a good decision. So to a certain extent, you must cover your rear end in terms of being able to justify yourself. And I think this being able to justify yourself simply says, I made the decision that was good at the time and was expected of me. Not only expected of me, because that can be a bad thing also, but it was a good decision at the time. And very little of the implementation of integrated reporting within a company is necessarily to provide persons within that company with a mechanism against which to measure, is this a good or a bad decision? So in retrospect, can you justify the decision? There's not a sort of a standardized tool against which to measure it. And then secondly, or coming back to my point about the transparency, is flowing upwards, there's transparency in the decision-making process, and flowing down, there's a clear view from the top, what is expected of you when making a decision. So even if you're working in the mailroom, you have clarity in terms of what you are expected to do. And it is this two-way flow of transparency up and expectation down that I feel that gap that you have been mentioning that exists in a company. It's what is expected and what is transparent are not necessarily always the same. If they don't work together with each other, I think you sit with a problem within a company. And this speaks to what was mentioned in the chat rooms. Everybody here says basically, how do I implement? How do I make people live the values, live the culture? But forget about the higher order things like culture and values. How do I make them understand what is a good decision, what is a bad decision? How you get there, obviously there's a process here that you can follow through Barrie and Jonathan. But beyond that, it is simply a good question to start asking at every level within the organization. How can we improve transparency, and how can we improve the communication of what is expected within an organization? Yes, Jonathan.
It's the hardest question to answer. There's no doubt. There's no doubt. for us, you know, the idea of the promise was a way that we can move employees living in very tight job description based silos. This is what I do, and you know, I know it's measured, I got my KPIs, and we're not suggesting that we go against that. But what we are suggesting is that, yes, while I will define what you do in the context of your position and everyone's kind of mapping of their place in the organization, there's this overriding promise. It's kind of like every contract that anyone writes. It has everything, but in the event of anything, you know, the good faith clauses and all these other things that come about. If you look at the catch no promise, it's a promise that everyone makes to everyone else. It's a promise that I can be held accountable to. So at any stage, I can be asked, so tell me, you said you would think about outcomes before you acted. What were you thinking?
Yeah.
You know, you said you promised to stay on track. Okay. So you know what you're doing, you know what you organize, what your particular area of business is. Are you on track, or are you just like doing nothing? So this promise becomes quite a catch-all obligation that rests on the individual and promise made to everyone else. And suddenly it changes. So we move from kind of like a contractual environment where everything is, I contribute to X and not anything X plus or X minus. And the definitions of that, we move into more of a promise and delivery environment at a personal level. And that naturally breeds a little bit more of trust between everybody, because we're all doing the same thing. It should, in good organizations where politics and other things don't play a role, start to increase the level of interactivity and delivery of actually what happens. But if people don't toe the line, okay, it's very easy to say, well, they're the promises that you made. So did you deliver on them? Because it's a condition of your employment. So in a sense, it's not just fuzzy in that sense. It's not just an esoterical promise. I mean, I have to defend my actions against the promise I made. And yes, so does the CEO.
Yeah. Yeah, that's a very important point that you mentioned there. And that basically speaks to trust.
Yeah.
It's delivering on what you intended to deliver. And there could be reasons why you couldn't. And a process that is transparent will also make it clear why you couldn't. But the point here being, I must be able to defend myself if I didn't, and have clear in terms of what is expected of me. And if I make a promise, I must deliver on it.
And if you don't, if you have a fair reason why not, and there's your moral.
Yes.
You see, trust is not a moral. Trust is a law. Trust is the way things work. Okay, trust, when two people are in a room, trust exists at a level between them. If no one's in the room, there's no trust, okay? But fairness is how you interact around the actual productivity of the things that you're doing. You know, if I'm fair and I can demonstrate I didn't deliver, but this is what happened, trust levels are not decreased, they may even increase.
Yeah. Yeah.
So the moral comes in at fairness, because fairness underpins trust levels.
Absolutely, absolutely.
And Brett, it all links back into the value system. I remember working with an organization, and one morning I came out of the lift, and there on the wall opposite the lift was a beautifully laminated statement of the 7 values, and that was fine. And I read through them and I thought, yeah, that's what I live by. That seems to be fine. And they might have been couched in slightly different terminology. Some months later, I had an occasion to remonstrate with somebody who worked for me and said, this goes against our values. And she said, well, yeah, but what are our values? I said, no, but they're on the wall. I'm being simplistic now, opposite the lift. Really? So we walked through to the reception, not to the reception, to the lift foyer, and there they were. The trouble with that, in that organization, is that the values were there, good values, sound values,
decision.
but they were not used in decision making. They were not a conscious set of values or a conscious culture that the values led to. So, look, when I say remonstrated, it was a discussion. There was no disciplinary thing involved there. But it was just a question of, it's all very well to have a set of values, but we need to live by them in what we do.
Yeah.
And as you mentioned, Brett, there may be times where I can't fulfill. Okay, so how can I behave fairly in that situation that trust can be retained? And so the value system, presumably, as I said a little earlier, should be designed such that it builds trust.
100%. Yeah. And I think that's actually a very good summary of it in terms of you guys have offered, or at least attempted to offer,
Let him finish now.
not necessarily the debate, but started the thinking around how to bridge that gap between the values that we want to have espoused in our organization and what we actually see in the organization. And if you see a company living its values, there immediately is a trust relationship with all of its stakeholders, because that doesn't mean you're going to treat everybody in the same way, but you are transparent in terms of why you are making the decisions that you're doing. So it doesn't say that, it doesn't necessarily tell you that you must all of a sudden be the most philanthropic company in the world, etc., etc. It simply makes it clear that we have a certain set of values that guide us in our decision making. And these are what they are, and we can deliver on them. And the problem, I think, the gap has always been that what we say we want to deliver on and what we really truly deliver on are two different things. There's that disconnect. And a way of measuring performance against the values is extremely crucial. And that is sort of what governance has attempted to achieve, but there's never been, I think corporate governance has sort of said the what, but not the how. It said we want to achieve this link, but there's not the how of this link. And hopefully, obviously we can talk about this topic, I think, for days, absolutely for days. But I think as a summary, it's why I wanted to introduce this topic to USB and the participants was, let's start that discussion of the how. I think we can all agree with what I've seen in the chat room, and I hope that we've addressed everything in the chat room. But what I've seen in the chat room is we all agree there's this gap, and it leads to, or there's issues around measurement, there's issues around performance, there's a lot of issues, but they all stem from the same thing. How do I make alignment between the outcomes that I want to achieve and the actual performance that I have? And implementing, or at least considering, debating, talking, discussing directly this gap is going to be required, because otherwise corporate governance is simply going to become a major over-legislated, costly, burdensome administrative process within an organization, when it could, in fact, I think this is what's the intention of corporate governance, become a living, breathing thing within the company to ensure that you have long-term sustained performance. It is a compass. It is a compass that tells you where you must steer your ship. And if you see a compass as a burdensome thing, you are not going to steer in the right direction. You're not going to know where you are going. So Barrie, I don't know if you have a concluding remark, and Jonathan, I don't see any further chats in the chat. If there are any other questions, you're free to also go. Otherwise, I will conclude with a thank you. But Barrie, or Jonathan, if you have a concluding remark.
No, I just want to thank you for the opportunity to chat about it. I think it's something we've spent a lot of time on, and we'll see how we begin to, because we're in the process of trying to produce certain tools in that, and we're in the process of making that available at some stage. So, but it's always to get the conversation going and to start identifying and get feedback. So this has been very useful. Enjoyed the feedback, and thank you everyone for signing in. Thank you very much.
Thank you.
Yes, thanks, Brett, and Christelle, and everybody who's been on the call. It's been interesting, and thanks for the comments through the chat room. Very useful. So thanks very much. and go safely, stay safe, stay well.